Hey guys, welcome back to another video. Today we're going to be talking about private company valuations for small to medium-sized businesses. So this video wouldn't be really relevant for someone that's looking to value a publicly traded business that's very large in size. This would be more ideal for small businesses that are worth $100,000, $200,000 up to businesses that are worth $40, $50 million in enterprise value. And just as a quick background, my firm, we primarily sell businesses, I would say within that $1 million to $20 million range. So this video is going to give you an insight into how I think through valuing companies when I sit down either on the buy side or the sell side with a client. So in this video, I'm really going to be talking about the three core valuation methods and which one is the most applicable for the video. I'm going to be walking you through the valuation benchmarks, how to understand the formulas and the multiples in the space. We'll talk about what current market multiples are in the small to mid-market today in Canada and the US. And then we're going to dive into the specifics, the value drivers and the value limiters that specifically influence the valuation of a business that you're looking at. And then there's a part 2 video. So I'm giving you the high-level concepts, kind of how I think through valuation. And then the part 2 video is going to show real-world applications. So I have 4 companies that I've changed the names and a few of the numbers, and I'm going to be walking you through the balance sheet, the income statements, and valuing those businesses, following this methodology. So let's get into it. So there are 3 key valuation approaches that you'll hear about. The first one is the discounted cash flow methodology, the DCF model. And put simply, this is trying to extrapolate the future profits of a business over the next 10 years and, if the exit value of that business, and discounting those future profits and cash flows to the present value. And so what you're really saying is I'm buying a stream of profit, and really the present value of all the future stream of profit plus what I exit with the business 10 or 15 years from now is really the present value that I'm willing to pay today. The challenge with that is that in the small to medium-sized marketplace, most buyers do not follow this methodology. There may be some form of validation to use this model to validate their returns to investors, but when you're pricing a business or when you're thinking about selling a business, trying to project out future profits and discounting them just doesn't make sense. A small business is naturally volatile. Customers can be 10-15% of the total revenues of that business, and if they change contracts or they switch suppliers, well then all of a sudden those projections go out the window. So it's very difficult to rely on the DCF model to value small companies sub $20 million in value. As you get to the $100 million mark or publicly traded businesses, this is the predominant valuation method, but not with small businesses. The second approach is the asset-based approach. And so instead of looking at the profit of the business, what you're saying is, hey, listen, I'm going to value this simply based on the assets on the balance sheet, the equipment and the real estate that's in the business, and looking at the market value of that total asset value of the business. And so typically you'll see here there are 3 different valuation approaches for the asset value. The first is simply the book value. I look at the balance sheet. I bought I paid $1 million for this piece of equipment. I've depreciated it by $300,000 over the last 5 years. Therefore, the net book value of that asset is $700,000. And therefore, if I tally up all those assets, the net book value of the total business is $2.5 million or whatever the case is. So that's number 1. I would say, to be honest, very rarely we see that transact if a buyer is using the asset approach. What's the more common method is number 2, fair market value. And that's really getting a current market appraisal of the assets in the business and saying, hey, listen, these 3 pieces of cutting machines, if I was to go and sell these assets on the open marketplace, what can I really realistically get for them? And usually they depreciate in value much quicker than the book value. So you'll usually see that fair market value is probably a little less than book value in most instances, sometimes not the case. And then in the worst case scenario is the liquidation value. So if you're an aggressive buyer or you're buying a business that is not generating any profit, the business is deteriorating over the last few years, you would really look at the liquidation value of that business to say, hey, at a minimum, if I were to just shut down this business and sell off the assets, what can I get for this in a reasonable course of time? And then obviously anything above that is management strength, my operational gains, and therefore that's my return that I would see on my investment, but I'm only willing to pay the liquidation value. Now we sometimes see these approaches being used, but again, I would say this is not a predominantly popular approach in the small to medium-sized space. What is the most popular is the multiple approach. And the best way I describe the comparable analysis multiple approach is just similar to real estate. Say, for example, I have a 3-bedroom, 2-bathroom house, and 2 doors down, someone with 3 beds, 2 bath sells for $1 million. We have very similar properties. Well, I could probably assume that if they can get $1 million for that house, then I can probably get $1 million for my house because we're very similar. So I'm trying to compare the value of my asset to other assets that are similar to mine that I've sold already, and what have people paid for them. Now, unlike in the real estate market where you can see total purchase price, in the small business space, you typically don't see the transaction value. It's not publicly disclosed. What usually is disclosed is multiples. And what that means is it's a multiple of profit, it's a multiple of revenue, it's a multiple of something, a benchmark that we'll get into. But, really, if that business that's generated $2 million in profit sold for a multiple of 6 and I generate $1.7 million, I'm close-ish to $2 million, and I could probably get a similar multiple of 6 times on my profit as well. So this approach is the most popular approach in the lower mid-market small business space because it finds a common benchmark across companies in an industry and zeroes in on that multiple and says, hey, listen, if you're going to get 2 times for your business, then I can probably get 2 times. Or my business is better, my business is larger, therefore I may get more than 2 times, or vice versa. So this is the most popular approach, and that's really the point of this video moving forward. I'm going to be talking about the multiple approach. So let's look at the formula. So the first side, over here is the value of the company. And really how you get it, and I've already talked about it, is you take a benchmark and you multiply it by the multiple, the valuation multiple. So there's 2 equations here. There's 2 factors in this equation. The first is the benchmark, the second is the multiple. So when you look at the benchmark, what do you use? I already kind of referred to profit, and usually I would say 80% of the deals that we see, they trade on a profit benchmark. So here, a $10 million business generates $2 million in annual profit, and a valuation multiple of 5 gives you your $10 million. So that profit is referred to as adjusted EBITDA, and this is the most common benchmark that you'll see used in the business valuation space. Now EBITDA is essentially earnings before interest, tax, depreciation, and amortization, and then you also adjust for owner expenses or any non-recurring revenues or costs that may have resulted in that business. And so what you're trying to do is you're trying to adjust and normalize the reported EBITDA on the financial statements to account for any discretionary or non-recurring costs. And so really that's a separate video. If you want to get into how you calculate adjusted EBITDA, I would recommend you watch my How to Normalize EBITDA video on the channel. But really, just at a high level, very common examples would be if I received COVID income of $100,000, that's only because of COVID, and it's not going to happen moving forward. Therefore, I would back out that income. A flip side is I had a one-time severance payment. An employee asked for severance. I bought them out. Well, moving forward, I'm not going to need to incur that $75,000 severance every single year, so I back out that cost and I adjust my EBITDA for it. And so this benchmark is really the most common one. Now, the number 2 is revenue. And in some sectors where either the business is not profitable or it's commonly accepted to use revenue, like in technology or like in software-based businesses, well, really what the buyer's looking for is simply to buy critical mass in the customer book. Because what the logic is that I'm buying your revenues, dropping it onto my infrastructure, and therefore my costs may be different than your costs. And the assumption is that I can take your revenue, drop it into my infrastructure, and get lower costs, and therefore generate higher returns and more profit on that business. So, when someone values it off of a revenue multiple, it's not the most commonly accepted benchmark, but you will see it in some instances. So technology companies, professional accounting firms, professional services firms would be another one. And then number 3 is very similar to the revenue, but instead of looking at the annual revenue, what you're looking at is the monthly recurring revenue. And the logic behind this is instead of looking at the last 12 months of revenue, maybe every single month my monthly recurring revenue increases and increases because I'm a fast growing business. So I don't want you to look at the last 12 months. I just want you to look at the last month and see how many contracts I have as of last month. And so this is typically seen, again, I would say in technology businesses and this is a very unique industry, but the alarm and security sector. So, alarm companies that are, providing residential security services, ADT or Rogers, Bell, these types of alarm services. they trade off of a monthly recurring revenue multiple instead of an EBITDA multiple. Because again, all the consolidators care about is I'm buying your alarm accounts and I'm rolling it into my cost structure. Now, the last benchmark that you'll see, and this is typically used for businesses that are asset heavy, is the adjusted EBIT, not EBITDA. And so what that means is that the DA, the depreciation and amortization, are not added back. And the logic behind that is, say for example, I have an asset heavy business. Well, to generate cash flows, to generate profits, I need those assets, and I need to invest in those assets on an ongoing basis. So really, capital expenditures, which is not accounted for on the profit and loss statement, is a real cost to the business. So what's a really good estimate of my annual CapEx spend? Well, it's what I'm depreciating on my assets, my depreciation amortization. So instead of adding back depreciation amortization and deducting the cost of CapEx on an ongoing basis, I just say, hey, listen, whatever I have to depreciate, I have to replace on an ongoing basis. And therefore, I'm not adding back depreciation amortization, and I price this off simply an adjusted EBIT multiple. And so adjusted EBIT is earnings before interest tax, and then adjusting for same thing, the owner expenses, non-recurring costs and revenues, the same things that we talked about here in number one. Now, a good sector that uses this would be the equipment rental business. Equipment rental businesses, again, my very businesses, I need to buy more and more equipment to feed the cog in the machine to generate more rental income. Therefore, I'm not going to be adding back my EBITDA. I'm going to be just pricing it off EBIT. Okay, so now let's flip to the other variable, the valuation multiple. So the valuation multiple is the key area of negotiation. This is really where, us brokers, buyers, and sellers, we constantly debate about what is the appropriate multiple to use. And this is the crux of the analysis for this entire video. It's fairly easy to find out what the financial benchmark is that's commonly accepted in your sector. But what isn't as easy is the valuation multiple. What multiple does this business generate? And so the way I look at pricing multiples is there's three buckets. The first is the fundamental drivers. This is more relates to the sector, where the business is located, the size of the business, not the internal company specifics. That's number two. So drivers relating to the current state of the business. It could be value drivers, it could be for value limiters. We'll get into those. But really the specifics of the business, how does that influence the actual value of that business? And then the last one is drivers or limiters relating to the outlook of the business. So I'm looking at industry, the specifics inside, and then the future of that very business. Because again, not only are you selling a business based on the historical cash flow, but also the potential of that business moving forward, especially if you have contracts coming in that are going to come in. So these are the three drivers of the valuation multiple, and we'll get into the specifics here. But before I do that, let's look at the market multiples in the space. So this is based on 2022. So we're just coming out of COVID in Canada. Shutdowns are over. And so now what are the multiples in the space? So typically there are multiple ranges based on the size of the business. And this is the best starting point. When you're thinking about business valuation, you want to get a range first and then apply the company specific variables to zero in on what area of that range, whether you're in the middle, the top, or the bottom. And that's really how I think about valuation. I look at the ranges based on size of the business, and then I zero in within that range on the specifics that relate to the specifics of the business. So Roblee Capital, my investment banking firm, here's kind of the market multiples that we would see in the Canadian marketplace. Now, the Canadian marketplace typically trades at a slight discount to the US. So if you're a US-based business is looking at this table, just know that it's actually a little higher. You probably have to add anywhere from half a turn to a full turn of EBITDA valuation on top of these numbers. But say, for example, I'm a $250,000 distribution business. That falls within this column or this row over here. Therefore, I may trade for 2 to 4 times. And then really how I'm set up, the profitability, the team, the customers, the suppliers, all the specifics will then determine where within that range I'm trading for. And what you'll see, and this is one of the key rules of valuation, is size results in a valuation premium. If you're very small, you have no infrastructure, you have no real sustainable value within the business outside of a few key employees or you, the owner, well, then you're going to trade for a lower multiple than if I'm a 7 million annual profit EBITDA business and, I have multiple divisions and teams and management teams in place. Well, then naturally the premium on the cash flow valuation is going to be higher. So that's why you see if I'm making 500,000 in profit, I may trade for 3 to 5 times, but if I'm making 4, I may be trading for 6 to 8 times. Now, these two tables here are now referencing more US-based multiples. So this is the private equity multiples within the sector. Same thing, you can see this is $10 to $25 million in value, 25 to 50, 50 to 100, and the 100 plus. And you can naturally see the average of the last few years here, so 2020 to 2015, if you're a $10 million business, you're trading for kind of in that 5.7 times range, which again, a $10 million business probably is a $2 to $2.5 million EBITDA business, which is you're right here. So really 5.7 would land right in between that range. So that kind of confirms this information source as well, that this is accurate. And then naturally, if I'm doing 50 on a multiple of maybe, I would say 5 million or 6 million in EBITDA. So if I'm a 6 million EBITDA business, I'm trading for 7.3 times. 6 lands within here, which is 7.3, which is dead in the middle between 6 to 8 times. So again, this confirms the valuations in the space. And then this is more US-based transactions. So this takes kind of 2021 multiples, and same thing. You can see here, there's no specifics on the bottom end, but if we take a $50 million deal, you can see that the $50 million deals in the US are trading for 9, 8.9, 8.4, 9.4. So a $50 million deal in Canada is trading for 7.3 versus 9, 8.9, confirming that there's a premium on the US-based businesses, and that has always been the case. So you'll see that if you're a Canadian-based business, you're not going to get the same multiples that a competitor in the US may get for you. So hopefully this kind of gives you a general understanding of really the ranges. And, I would recommend that you keep this table in mind, because as we go through this video, this is the starting point of all our valuation discussions. So let's look at the steps. So the steps in valuing a business are very simple. The first is you have to get, at least 3 years of financials. You want to normalize the shareholder costs, the salaries, the expenses, and normalize and calculate that EBITDA, that adjusted EBITDA, because that's going to be the benchmark that you want to use to value the business. So that really, once you've calculated your normalized EBITDA, then the second variable is the multiple, and the multiple relates more to the qualitative and specifics of the company, not really the financial performance as much as more the qualitative side of the business. So when you look at that calculated EBITDA, the next thing is you want to determine the multiple range. So if I've calculated my EBITDA and I'm generating $1 million in EBITDA, I go back to the table and say $1 million to $2 million probably trades to 4 to 6 times. So I know my range is around 4 to 6 times on my $1 million in EBITDA. And then number 4, I want to now incorporate company-specific value drivers and limiters to determine where in that multiple range I will be. Because no one's, is going to have a serious conversation with you if you say, hey, I'm worth $1 million and I expect 4 to 6 times. Well, that's a huge range in value. That's $2 million in value difference. Which one do you believe you are? Are you a 5 multiple? Are you a 4.5 multiple? So that's why you want to kind of incorporate number 4, the value drivers and limiters of the business. And then lastly, when you're valuing a company based off of a cash flow multiple, you're looking at the value of the enterprise based on profit, but there is also value on the balance sheet. So the way I always explain to clients is, when I look at valuation, I look at your balance sheet value plus your enterprise value plus your goodwill value. So really, in addition to the value of the normalized EBITDA times the multiple, there's also the excess balance sheet value. And so typically when you sell a business, it closes on a cash-free, debt-free basis. That means that any cash on the balance sheet is dividend out to the seller, and any debt on the balance sheet is paid out prior to the business being delivered to the new buyer. So you want to net your debt minus your cash, and whatever outstanding cash is left, that's excess value. And then in addition, say for example, you have a property or you have assets that are not really needed for the business. These are non-operating assets. Well, those you would take off the balance sheet and sell off separately, because again, the business doesn't need those to survive or to generate the business's value. And then the last thing is, I may have working capital. Say for example, I bought 2 or 3 years worth of inventory, but historically I only need 1 year's worth of of inventory to support my business. Well, that extra 1 or 2 years of inventory, I just bought simply because I had the cash on hand, or I got a certain deal on it. Well, there's excess net working capital value there that is worth something. And so buyers will pay you for that excess. The flip side is, say, for example, I drain the balance sheet. I quickly collect on the accounts receivable. I'm extending my suppliers. I'm not paying them, and we're in a negative working capital position. Well, in that case, the buyer's going to say, hey, listen, I need more working capital to run the business. If I'm going to pay for the enterprise, I need a sustainable amount of net working capital in the business, which we refer to as the net working capital target. Again, there's another video on my channel for this, but this is just more of a high-level explanation. And so, if you're able to deliver a sustainable level of net working capital, anything above or below that, which is the actual amount on the balance sheet, would get either credited or deducted away from the purchase price. In most instances, I would see most businesses have some form of excess net working capital on the balance sheet. And we'll go through that in part 2 when we go through some examples. So now let's delve into bucket number 1 in determining the multiple. Let's look at the high level. Before we dive into the company, we need to understand where the company lies in a few areas. We already talked about number 1. The first thing I always start is, what's your EBITDA? Well, I'm a 1 million EBITDA business. Okay, think to my table. Oh, he or she's going to probably trade for 4 to 6 times multiple. So transaction size based on EBITDA determines your EBITDA range. The next is the type of buyer. So it's really important to understand who your audience is when you sell a business. So I always ask the seller, are you open to doing a broad auction, selling to any buyer that's willing to pay the price? Or are you hesitant to approach anyone in your space? You don't want us to talk to any competitors, et cetera, et cetera. So if you limit the range of buyers that are willing, and you therefore shorten the size of the pool of the buyer pool, then naturally you won't be able to get a higher premium for the business because there are fewer buyers at the table. But if you're willing to run a broad auction and generate a lot of interest in the business, go to competitors and people that are in your space and know your business very well, they are more comfortable in paying a higher valuation for your business. So the second consideration that's not really related to the business, but the more specifics of that seller in the process, is how many buyers are in the room and what type of buyers are you talking to. The third factor I consider is the sector. What's the outlook of the sector? If you're a printer, printing sector right now is in a declining area of the cycle. People are moving away from print to digital. Naturally, the outlook for the print sector is very poor relative to maybe a software-based business that's growing in that space. So you always want to look at, okay, yes, I may have $1 million in EBITDA, but if I'm a software business with $1 million in profit, or I'm a printing company with $1 million in profit, the multiple ranges are going to be significantly different based on the sector. Number 4 is access to financing. A lot of people forget this. If you're not a bankable business, say for example, you work in a very dangerous or taboo sector like tobacco manufacturing, your access to financing, the number of investors that are willing to raise financing to back a deal is more limited than if you're in a hot sector or you're in an environmentally social conscious type sector where everyone wants to be in today. So you want to always think, how much access to financing do I have as a business have and the buyer will have to finance a purchase? Another really good consideration is, say for example, the financials are incorrect, the systems and the processes, they're very dated and you don't have really accurate numbers. Well, then some banks are hesitant to lend or will lend less than they usually will for a similar sized business. Therefore, if there's lower access to financing, the multiple range naturally declines. And then the last one is terms. I always say this, terms dictate price. If a buyer really wants only cash in a deal, that will result in a valuation discount because buyers are always looking for some sort of risk sharing. The seller is going to lend some money as a vendor note or share in the future performance of the business through an earnout, or maybe hold a piece of equity in the business moving forward. Whatever the case is, if the seller is willing to provide terms, that naturally provides more comfort to the buyer, which pushes the valuation range up. But if a seller is saying, I want out of this thing in 3 weeks, I want only cash, I'm not willing to take any vendor note, out or vendor financing, naturally buyers are going to be willing to pay less because they don't know, why is the seller not willing to stand with the company and wait a year or two for their money? Okay, if you want the money quick, I'm going to apply a discount to your valuation. So that would influence the specifics of that value. Now, number 2 is the value limiters. So looking at anything within the company that limits the value of the business. And so these are probably the 6 common areas that I see a small business or lower mid-market company has that limits valuation. The first is customer or supplier concentration. Oftentimes, a small business grows a few of their key customers, and they will make up 20, 25, 30% of that business's annual revenues. If one account makes 25% plus of your revenues, that's considered a substantial customer. And if you lose that customer, the value of that business changes so significantly that buyers are applying a discount to your business. So a really good example is where we were selling a business where their top customer for 30 years, they were the top customer, was 50% of the business. But buyers are hesitant to step into that relationship because when you sell a business, there may be personal relationships with that customer that they don't know about. There may be customer changes that may come up. That may be the reason why the seller's selling. And so they're hesitant to step into such a critical, important customer relationship. So the challenge in that scenario is you have to provide more terms. You have to be more risk sharing from the seller perspective to allow the buyer to get comfortable with that concentration. But this would be one of the primary value limiters. And so that business probably traded for a whole multiple, 1 turn of EBITDA less because of that customer concentration. The second one is owner involvement. Now, this is typically very common in small businesses and even in lower mid-market companies where the owner and the seller now is doing multiple key roles. They're working 80 hours a week or they're working 60 hours a week. They're doing pricing, sales, purchasing. They're managing the strategic direction, all HR. They're doing really all the key management roles, and the staff are more taking direction than thinking independently. Well, in that scenario, if the seller sells and they're not willing to provide a really smooth transition, or they run away and they bugger off with the money, well, then all of a sudden you have nothing left as the business owner of the new business owner, because who's going to train and transition that business? So whenever there's a company that has very little middle management, any responsibility that may be delegated is seen as a positive. But if that seller does not trust their staff, then the buyer is going to have a very tough time transitioning that business without the seller support. So again, that typically limits the value of the business. And that feeds into number 3, which is the anticipated transition risk. Usually buyers, when they look at valuing a business, one of the first questions they care about is the business that I'm buying today going to continue on for the next year? Because beyond that, I'm going to make changes. But I need the business to sustain itself so that I can learn it, can get into it, and start operating the business as a new owner. Now, if that transition risk is very high, meaning that there's customer concentration, key owner involvement, a lot of family members in key positions that are quickly leaving post-sale, in that scenario, there's a high transition risk, which limits the value of the business. But on the flip side, if there's a big team in place, the owner's not involved, works very little in the company, the customers are contracted in nature, the transition risk is very low, and therefore there's a premium associated with that business. Now, number 4 is the historical financial performance. So naturally, a lot of buyers are looking at, and I'll show you this in part 2, the EBITDA margin, the gross margin, the cost structure, the revenue levels. Are they growing up? Are they going down? Are they flat? Why are they flat? Why are they growing? Are they growing too fast because of one key customer? Or are they sustainably growing because of, winning market share on a sustainable basis? So, you really want to dive into the financials to understand, what is happening. And I would say if gross margins are declining, the revenue is very volatile or project-based, that typically limits the value of the business because, again, there's not a lot of sustainability, and the transition risk increases from the buyer's point of view. Now, number 5 feeds into that as well. Pricing power means that I'm able to charge a premium for my services. If I'm in a commoditized sector, like I distribute steel, and I don't do anything with that steel, I just distribute it, I buy it from China, bring it to the US, and then distribute it, I can mark up a 10 or 15% gross margin, but I can't mark it at 40% because there's other people that are going to sell that steel for a very lower price. So what is my pricing power as a supplier to my customers? And so pricing power usually is reflected in the gross margin. So if a business has 45, 50% gross margins, that means that they probably have very good pricing power based on their cost base. On the flip side, if I only have 15% or 20% gross margins, that reflects that I probably can't mark up my product or services as aggressively, and therefore my pricing power is more limited. So 4 and 5 kind of feed into each other. When you're looking at the financials, you want to think, what's the pricing power of that business? If it's very low or the margins are very low, then I'm susceptible to high competition. Other customers can switch, and they'll switch for an extra 2 or 3% of a decrease in their cost. So, again, how sustainable are the customers? That is reflective in the pricing power as well. And then the flip side, number 6, is winning new customers. How easy or hard is it to win new customers? If customers can quickly switch between suppliers, that means that maybe the loyalty of that customer is limited, because they'll quickly decide based on whoever's the cheapest in the marketplace. But if the switching costs are very high and it takes months to transition in and out of a supplier relationship and onboard a new supplier, then that typically results in more sticky customers that will stay with the business for the long time. And that's really what buyers want. They want stickiness to their customer base. So now flipping to the value driver. So we talked about what limits the value of a company and pushes down the multiple range to the bottom end of that range. Now the number 3 focuses more on what pushes it to the top end of the multiple range. And so number 1 feeds off the last point, which is the stickiness of revenues. The most important thing that buyers are looking for when they're buying a business is the stickiness of customers. Are customers contracted? Are customers dependent on this business? Are we a critical supplier that, if they try to leave us, that could really hurt their business? Because what that means is, if there's a bump in the road as I'm transitioning this business, or I'm trying to make tweaks and changes that don't really work and I'm going to learn on the job, well, those customers are not going to quickly leave because they can't leave. And that sustainability of that customer relationship is so critical because it lowers the transition risk for the buyer, which results in a premium for the business. Now, number 2, we already talked about this, pricing power. So if you have a higher pricing power, your profit margin is going to be typically higher. And what I typically look for a really healthy business that's trading at the top end of the premium is a 20% plus EBITDA margin. Because if your EBITDA margin is sub 10%, I look at that as saying the pricing power is very limited. If it's between 10 to 20%, I would say that's an average net profit. Nothing too spectacular. But if you're generating 20+% EBITDA margins, that means that you are consistently marking up your labor. You probably don't have very high inventory or capital costs to deliver that service or product. And, that is sustainable pricing power that buyers are willing to pay for. Now, number 3, the historical financial performance. In a scenario where margins are increasing, revenues are increasing, that's good. You want to see that the business historically has consistently grown over time and is winning real substantial market share, and then buyers will pay for that. Now, number 4, these are all kind of the vice versas to the last slide. So middle management. So again, you want to have staff that you've delegated as the owner responsibilities to middle management staff. They're handling sales. They're managing customer supplier relationships. The owner may be managing the strategic direction of the business, but not really the day-to-day business or service delivery. And that's really gold, because that means that the buyer can come into the owner's role and still focus on working on top of the business rather than in it. Because I would say one of the biggest mistakes that buyers make is they buy a business and they're really buying another job, because they're stepping into the owner's shoes, who was working 60, 70 hours a week and was barely staying on top of their responsibilities, and they're unable to work on growing the business because they're now on the treadmill. They now have to cover all these different positions on the team. Whereas if you have a middle management, you right away step into a role where you're focused on growth and doubling the size of the business to generate those returns as a buyer. The flip side to that is low staff turnover. One of the things that I always ask for is, based on your staff in the last 3 years, how many roles have changed over, or based in the last year. And I've heard businesses that 60% of our staff has turned over in the last year, and it's like, wow, okay, what's going on? Are they paying below market? Is the culture very poor in the business? Is the management poor, and therefore they're very hard with their staff? Whereas on the flip side, if you're talking to a business where it's like, we've had, of our 30 staff, 15 of them have been with us for over 20 years. and many of them have been with us average 10 years, 7 years or 8 years, there's probably something there, whether it's good culture, steady compensation. There are things that retain staff. And so you as a buyer are always going to be cognizant of, I'm stepping into this new business. I don't know what I don't know. And one of the good indicators is staff turnovers. If people want to stay with that business, probably they're doing something right. But if a lot of people are leaving all the time, something's going on there. And I need to understand that as a buyer. And typically that limits value. Then number 5 is low capex. So we kind of talked about this before at the benchmark slide. But typically, if you're a business that requires a lot of equipment, a lot of assets to generate revenues, that means that you have to spend more and more on capex every year to replace and replenish that equipment base. Now, that's a real cost to the business, which limits your cash taken out of the business on an ongoing basis as the new owner. Whereas if you were a low capex business, meaning that you're really only delivering services, you may need some tools or hand tools and that's it, maybe a truck on the road, but you don't need a big 30,000 square foot manufacturing facility or whatever the case is. Therefore, more of your EBITDA is going to convert into real cash in your pocket as the new business owner. And a lot of owners are return based. They're looking for a rate of return based on the free cash flow of that business. Yes, they'll price a business off EBITDA, but if you're consistently spending $50,000 to $150,000 a year in capex, that in the back of their mind is going to limit the multiple that they're willing to pay for that business. And we always talk to buyers, the wish list is always contracted revenues, low capex, service based, because that's the trifecta that drives value. And a lot of people are willing to pay a premium for that. The opposite to that is commoditized customers, low pricing premium, high capex, asset heavy businesses. In that instance, typically the multiple range is on the lower end. And then the last point, number 6, is capacity for growth. And so this one people sometimes forget about, but it's really important to understand that, when I always think about a business, I'm not only buying the business for the cash flows today, but where I can get the cash flows tomorrow. And say, for example, I own a manufacturing facility and I'm running at 99% capacity right now. I cannot add more revenues. Well, even if I as a new ownership group have really interesting ideas to grow the business, I can't implement those ideas day one because I need to spend real money to expand the capacity of the business. Whereas if I have a lot of capacity to grow, then not only am I paying a premium or paying for the business today, but I can quickly grow that business and generate a rapid return. So buyers will always pay a premium if there's room for growth, if there's a runway where they can see that the business is going to grow quickly. Whereas if there's very limited capacity or you can't grow very quickly in the next 2 to 3 years, then buyers will apply a value limiter to that and push down your multiple range. Okay, so those are the 3 drivers and buckets that I always think about. I start at the top, I normalize EBITDA, I get all the financials, I sit down with the owner, I hear their story, I understand their business model, I get a really good glimpse into what the outlook of the business is, and then once I calculate the normalized EBITDA, I start working from that range. I look back to that range and I say, okay, this business trades for 4 to 6 times. Is it a 6 or is it a 4x? Because that's a big difference. And then based on the conversation with that seller, I always drill down and say, okay, I have almost like a matrix, and I'll show you this in part number 2, where the matrix has all these key questions: room for growth, customer concentration, supplier concentration, boom, 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 boom. As you work through that list, you'll be able to tally up the positives and the negatives, and that will typically put you within a very tight range of half a turn of EBITDA to say that this business will trade for not 4 to 6 times, but 4 to 4.5 times based on the value drivers and limiters. And so that's really what we're going to do in part 2. These are the 4 companies. It's an HVAC company, a metal fabrication, home renovation business, and a commercial printer, all with various revenue levels and EBITDA levels. These are real world examples based on transactions that we've worked on in the past or that I've seen from other colleagues. And I'm going to be taking the high-level financials and customer information and going down that list with you through that matrix and applying the value limiters and the drivers to zero in on the right valuation range. And this is what the most common approach to valuing a small to medium-sized business is. So again, hopefully you found the video very helpful. If you did, please do like and subscribe to the channel for more of these videos. Please stay tuned, or check out part number 2 if it's already posted. And then as well, if you have any questions, then you can reach out through LinkedIn or through my my website at Roblee Capital. And obviously, if you're a business owner in Canada that is looking to sell, I would obviously be very interested in sitting down with you to learn more about your story and hopefully helping you out as well. So take care, everyone, and have a great day. Thank you.